All right, let's take a look at what's happening with stocks out the gate here this morning. We mentioned we are positive, although it is tricky. I mentioned that investors were seeking the safety of bonds, in part given the worries tied to the Israel-Gaza war. And when you're buying bonds, that ultimately puts pressure on yields, which had been surging recently. And so that did help to boost the mood of stock market investors. We did get that hotter than estimated inflation data in the U.S. On the inflation front, prices paid to U.S. producers rising more than forecast in September. Gasoline was part of that story. The PPI data coming ahead of key consumer inflation numbers out tomorrow in the U.S. And obviously investors trying to assess what the Fed will do at its next rate meeting. I mentioned we're going to get the minutes from the Fed's most recent interest rate decision at 2 o'clock Eastern today, so we might get some clues there. And a reminder that Canada has its next interest rate decision October 25th. Now, we did mention we've got some signs of confidence on the deal front. You had Exxon acquiring Pioneer, Spin Master acquiring Melissa and Doug, and then we've got a big IPO today for Birkenstock. And then, of course, is the earnings story. We saw PepsiCo with some well-received results yesterday. We'll be watching Canadian companies through earnings season, and we'll be digging through the big U.S. banks, which are set to report their results at the end of the week. Doug Peta is chief strategist of U.S. investment strategy at BCA Research. He joins us now with what he's been watching. Doug, of all those things, thanks for joining us. What's top of mind for you right now? What's your focus area?
We really want to know what's going to go on with inflation going forward, and we're also very closely monitoring the state of the business cycle. Now, all the things that you described in those headlines, big deal, big acquisition deal for Exxon, PPI coming in a little stronger than expected, good numbers from Pepsi, other acquisition activity, it all says that we're still in the expansionary phase of the business cycle, although we do believe it's late in the expansion. That's often when you see these deals. And so we really want to try to catch that moment when we go from expansion to contraction.
And on the subject of contraction, have you made any predictions on what kind of economic road we're looking at ahead?
You know, our best guess, and because no one knows exactly when a recession is going to occur, our best guess is that the recession will begin sometime in the first half of 2024. It's our view that the consumer was much stronger than the consensus realized coming into 2023, and that accounted for the very premature, widespread expectations for a recession. But we think the recession has merely been postponed, not canceled, and that we will see the economy slip into contraction sometime in the first half of next year.
And I'm going to assume that's a U.S. call, but you can correct me. And I guess the other big question out there is then what happens to interest rates if we're all of a sudden talking about recessions in 2024?
We would certainly think that a recession would take the upward pressure away from interest rates. It's our view that rates are near a top. We think the Fed is finished hiking rates. And as you mentioned, maybe we'll get a little more insight when the minutes come out today. But more recently than the minutes, we heard just at the beginning of this week that a couple of Fed officials noted that with the backup in interest rates that's occurred, that the bond market has done some of the Fed's work for it, and that therefore the Fed can afford to be more cautious when it comes to hiking interest rates because you're already seeing tighter financial conditions because of this backup in yields.
And one of the big questions I think a lot of investors have is, on the one hand, if you've got a recession, that could be a challenge, to say the least, for some parts of the economy, stocks that are associated with that downturn. On the other hand, people had been hopeful that at some point you would see the narrative on interest rates change, and people start pulling out the history books and looking what happens to the stock market when you officially start to see that change in the trend for interest rates. So how are you thinking about investing strategy against this backdrop?
We came into this year wanting to overweight equities and underweight fixed income, and we maintained those recommendations until mid-August, when we went to equal weight equities and equal weight fixed income. Right now, we are looking for an opportunity to get underweight equities and overweight fixed income in advance of the recession that we expect, which historically has always meant that stocks are going to decline and decline meaningfully. and that bond yields are going to fall. Therefore, bonds are going to generate capital gains. They're going to appreciate in value, in addition to providing investors with an income stream. So, it's all about where is inflation going? What is that going to mean for the Fed? And independent of the potential for the Fed to hike rates more, if we would see inflation revive and reaccelerate, it's about when does the economy flip from growing fairly robustly to barely growing at all or contracting, and thereby a recession ensuing, when we would want to go to that much more defensive sort of asset allocation.
Now, if I think about sectors that make up the stock market, because you said you wanted to be overweight equities coming into the year, even though things have started to get a little dicey out there, I'm looking at tech as a component of the S&P 500, and in percentage terms, you're still looking at quite a big gain this year. I look at energy stocks and financials, and I'm speaking mainly through the lens of the S&P 500, but there's a lot of mirroring for the Canadian market as well. And I see those sectors in negative territory for the year. So if you're shifting exposure to the stock market, are there any particular sectors that you're more cautious on?
Sure, and when I state this, it's like when the Fed officials issued the disclaimer that what they say does not apply to all of their colleagues. So this is a U.S. investment strategy view. This is not the official BCA view, but we want to overweight the late cyclicals, energy, industrials, and materials, and underweight defensives, consumer staples, healthcare, and utilities for we think the rest of this year. As long as we remain in an expansion, we do think the late cyclicals, and they're named late cyclicals because they tend to outperform late in the expansion, we think that they are going to thrive relative to the over-owned defensives, where a lot of investors fled at the beginning of the year when they anticipated that a recession was nigh. So until we get that flip of flipping from equal weight equities to underweight equities, within equities, we are going to want to overweight those late cyclicals, energy, industrials, and materials, while underweighting the defensives.